Good evening, everybody, and welcome to another Life After Hours with Life Sherpa. For those of you who don't know me, I'm Vince Scully, founder of Life Sherpa and author of the book Live the Life You Want with the Money You Have. Tonight we're focusing on the topic of insurance, which may not be the most exciting topic, but it's certainly one that raises lots of questions with our members. So it's great to have you here tonight, and hopefully we can answer your questions as they come up. So pop them in the chat and we'll get to them as we go. So we probably shouldn't indulge those people who can't turn up on time, so maybe we'll get started. So as I said, we are talking about insurance, and that's part of the broader topic of preparing for the unexpected. So as always, when we talk about finance at Life Sherpa, we bring everything back to our 8-step methodology. And today we are talking about the step 4, prepare for the unexpected, which encompasses a whole bunch of things that together make up what I call the plan you need for when the plan you have doesn't go according to plan. And life being life, that very rarely happens. So when things don't go according to plan, we can look at those in two dimensions. There's the likelihood of the event happening and the impact on our lives, particularly our finances, when they do happen. And the human brain's not particularly good at dealing with topics which have a low likelihood of occurring. We tend to focus on the things that are most likely to happen and deal with those. So you can sort of look at these in a 4-box matrix. On the left-hand side here, we have the low impact items, which are maybe more or less likely to happen. So if we start with the things that are highly probable to happen, but when they happen, they have a relatively minor impact on our lives. And for these, because they're going to happen all the time, we should just build some fat into our budget. So that's the contingency in our budget. There are other items that have similarly low probability of happening. Also, just have a look at some examples of these. You drop your iPhone, your car needs a repair, your kid gets sick, or your kid loses their glasses on the bus. All of these are relatively small events. For the ones that have a lower probability, that's where we use our emergency stash. So things that don't happen every year, that's where our emergency stash comes in. But when we start looking at the things that have a much lower probability of happening, but a much higher impact when they do happen, these ones are usually so big that you can't realistically save enough money to deal with them. And an emergency stash that large would be very inefficient and very difficult to put together and keep. And that's where insurance comes in. So insurance is really about sharing the load with other people so that we all wear the average cost of this event happening, and those for whom it happens below average times end up subsidizing those who do. And that's because these events are just too hard to manage on our own. And I said the human brain's not particularly good at dealing with these because of the level of probabilities. But some of these probabilities are much higher than you might think they are. So 1 in 10 men will die between the age of 30 and a normal retirement age of 65. Women generally live longer and are healthier. The number for women is about 1 in 15. And when you put those two together, that leaves you with 1 in 6 couples or households will lose one or other of the members of that household during their working life. And when you look at it in those sort of contexts, it becomes a much more real probability. But of course, most of these events don't involve death. They involve interruptions to our ability to earn a living. So 1 million Australians, which is 1 in 20 odd Australians, have or will have had cancer, and 70% of those will live longer than 5 years. So it could be quite a long length of time to live with those impacts. Almost half of Australians will experience a mental health disorder at some point in their life. And a quarter of adults will be out of work for at least 12 months because of disability illness during their working life. These are all pretty significant events. And it means that if you depend on your income to pay the bills or achieve your goals, you need to be able to protect your ability to earn that income. You need a backup plan in that context. So how big is this loss? So when we talk about insurance generally, we look at what is the potential loss. So if you're looking at insuring your car, you go, well, how much is my car worth? If you look at insuring your home and contents, you say, well, what would it cost to rebuild this in the event of a fire? What would it cost to replace my belongings? And the same goes with your income. And over a lifetime, that can be a very significant sum of money. So if we think about an example, Bobby, she's 30 years old, female, married, and makes $100,000 a year. Over the balance of her 35-year working life, she will expect to earn $5.7 million, so 57 times her current year's pay. And that's a combination of inflation, multiplying any number by 35 becomes a big number. But over her lifetime, she's going to earn $5.7 million. So that's the first metric of her loss. If she's unable to work, that's a $5.7 million loss. There's also the added cost of living with a disability. Now that could be anything really, from very minor to the cost of 24-hour care. Now, generally, the bigger that number, the more likely you are to have an impaired lifespan anyway. So the numbers tell us that the average is around 30%. So that's what we allow for in work. So that $5.7 million plus 30% gets you to 7 point something. So the first piece of insurance we can use to help to fill that gap is to start with income protection. And that can fill 70% of your income, which is the dark green band on this chart. But there's still a gap. So income protection will fill 70% of that gap. And for Bobby, professional, age 30, that's just over $1,000 a year to buy that. The older you are, gets a little bit more expensive. The more blue-collar work you do, the more expensive it gets. If you smoke, it gets a bit more expensive. But professional like Bobby, it's about $1,000 a year. Guys tend to not get ill as much. We tend to live shorter lives, but we tend not to get as ill for as long. And that's about 3/4 of that, so about $730 a year. And that's with a 90-day waiting period. By having a waiting period between the inability to work occurring, so the illness commencing, and the payout starting, allows you to save a lot of money. So you could buy a 30-day policy where it cuts in after 30 days, but that can be quite expensive. And most people have some annual leave and some sick leave. And we'll come back and look at how that works later on. And because it only replaces 70%, we're still left with a gap. And a large number of people claim on this. So 1 in 84 policyholders claim on their income protection every year. And that means if you spread that out over a 40-year working life, that gives you almost a 50% chance of claiming for something during your working life. And those claims are usually, for things like accidents, motor accidents, household accidents, sports injuries, the usual bad back, musculoskeletal problems, mental disorders becoming a much bigger chunk at 11%, and cancer at 10%. And then the balance of a quarter is made up of just about anything else. And includes strokes, heart attacks, that sort of thing. And so now we have to work out, having filled that 70% gap, how do we look at the gap between there and the total loss? And the first piece of cover we use is what's called total and permanent disability, or TPD insurance. And that covers what the name would suggest. It's for total disability. So the fact that you are unable to work completely and unable to work for the foreseeable future. So in insurance speak, that is unlikely to ever work again. And that's a relatively rare event, but nonetheless could be crippling. And that's why it's relatively cheap to buy. So we could cover that $1.7 million missing gap. So $1.4 million of cover for either guys or girls would be about $500 for our professional 30-year-old couple. And then the next gap is what we call trauma or critical illness. This is where the illness may or may not take you off work. Particularly important for women who tend to get a lot of diseases. Think breast cancer, cervical cancer, which are unlikely to kill you these days with the quality of medicine, and they may not stop you working for a long time. But quite often what they do is take away the desire to work. They often focus the mind. They often require emotional support from a partner. And so critical illness just pays out a lump sum as soon as you get the diagnosis from the doctor. And that money can then be used for anything. And noting that our females are much more likely to claim, they're a bit more expensive again, $342 for $200,000 of cover and for a female, and $255 for Bobby's husband. And they, together with the more traditional life cover, which deals with when you actually die. Dying's relatively cheap because most of your expenses disappear. So you stop eating, you stop wearing clothes, you stop travelling to work. But often it imposes additional costs on the household. So you may need additional help with housekeeping or childcare in order to keep earning the partner's income. And so for Bobby, in this particular case, the cost of that loss will be $635,000, which can very cheaply be insured for $123. And because guys die more often, they're a bit more expensive. In this case, $194. So that means that a comprehensive package that would deal fully with that loss position would amount to about $2,000 for Bobby, and just slightly less than that for her husband. And typically what you're looking at is about 2 to 5% of your income is the sort of number you should be expecting for a fully comprehensive cover policy. So, if you're trying to put that in perspective, think about that as the choosing between two jobs. One job that pays $100,000 with the normal 10 days sick leave a year, and another job with infinite sick leave, and they still keep paying you when you die, for $98,000. So that puts things in perspective. And so in practice, with the plan you have for when, so the plan you need for when the plan you have doesn't go according to plan, a few weeks, that's what you got sick leave for. A few months, that's what your emergency stash is for. And by having an emergency stash, you can afford to have a longer waiting period. And so your emergency stash is saving you money on your insurance. For a few years, that's where you have insurance, and possibly forever. So that's really just trying to put those in perspective. These insurance packages that are historical artifacts that we've just come to been passed down to us over the generations. Nobody has really innovated around these products, so we still have to build a package out of these 4 products, and that requires a little bit of thinking, and that's where your Sherpa is here to help.